Welcome back, everyone, to Lunch at the Market. I'm sitting here twiddling my thumbs, wringing my hands over our terrible trade today. That's right, I used the gigantic move in Molycorp to buy back our short put spreads. You know what that means? That means I get to watch Molycorp go ever higher and wondering what I really could have paid. How little could I have paid to take them off? Look, guys, you can't trade like that. Seriously. If you spend all day thinking about the trade that might have been, then you're just going to spend all day thinking about the trade that might have been, and you're going to miss the opportunity for the trade that's in front of you. So we had a situation where we sold a ton of Molycorp put spreads. I mean, a ton, not a small amount. And the stock ripped higher, and we got a chance to capture basically 76% of the profit in which we sold the spreads for. So let's take, for instance, on a 40 lot, we sold it for $1.12 on a 40 lot. That means we took in $4,480. That's a lot. That's more than most people's mortgages. That's more than most people's mortgage on their block. Depends how big your block is, though. I can't say your whole street, but maybe your block. Anyway, you get the point. It's a lot of money. Okay, so we've spent about $1,200 to take that back. So if I say 1,200 divided by 4480, then we got about 73.3% profit. You know what? That's not a bad X number of weeks worth of work. You know, even if that was on an annual basis, you would be happy with 73% of the possible gains that you could have potentially achieved. So here's what you do. The reason that we took it off is because the risk reward became disproportionately not in our favor. That means it could be bad for us. On a 40 lot, again, we're just using examples here, but this was a meaningful position for us, meaning the size was pretty good. So take example, on a 40 lot, max risk is $5 times 40 contracts times 100. You're talking about $20,000 in risk to potentially make another $1,200. Guys, the math doesn't work out. The right thing to do when you're up that much and you have that much risk left on the table is just buy back those cheap options and move on with life. If you try to capture every stinking penny, can you get it? Sure. Molycorp might be 80 by expiration for all we know, which is why we have a trade later on in Molycorp, like the one that we gave you last week for September. But it's irrelevant in terms of the spreads that we sold for June. The smart thing to do is to take those puppies off the table because the risk reward is no longer there. Look, when we were risking $20,000 to make $5,000, by all means, right? Let's make some money. But now we're risking $20,000 to make $1,200, and we only have 3 weeks until options expiration. So the risk reward isn't there. So that's a Molycorp trade today. We bought those back, and it's okay. We're not going to cry over spilled milk, even though technically if we did it right now, we could buy it back for like 25 cents instead of 30 cents, which would be a better price. But again, you can't pick the bottom, and you can't pick the top, and you probably should stop trying to do that. Otherwise, you'll lose money trying to top tick. Although we did get close to bottom ticking CF Industries, ticker symbol, surprise, CF. CF is an ag play much like Mosaic or Potash, which we've already told you all kinds of nifty fun facts and numbers and figures about Mosaic. That trade working out muy bueno. So we thought we'd go after CF Industries because after 5 days of ripping to the upside, actually, it might be more than that. It might be the Wednesday before that. Anyway, if you look at a chart of CF over the past 10 trading sessions, you'll see that it's up pretty significantly. But today we caught it down over $2. It was down about $2.40. Boom, we went after it with the July and the August 140, 135 put spreads that we sold. We got more than $1 for both, and we are down and out $13. This stock can move about 10% to the downside, and we're still okay. Plus, it's way out on the calendar. Well, not way out, but July is the next options expiration, and of course, August is after that. Company doesn't report until, let me get that day for you, I think it's the 1st of August. For Potash, reports July the 28th, so obviously we're probably going to see some pin action there. Whatever Mosaic, Potash, and CF Industries do, they're pretty much, until we've seen all the earnings from all three of the companies, you're going to get pin action out of all of them, because the first one you get is just as good as the other ones, right? It's kind of like JP Morgan. JP Morgan reports and everyone tries to figure out if everyone's quarter is going to be as good as JP Morgan or if it's going to be worse. And then people start trying to make bets ahead of the... Anyway, that's pretty much what happens. That's what pin action is. The first player kind of let us know, kind of peer back the curtain and let us know how they're doing. Then we extrapolate that out to, do we think that the other companies in the space are doing just as well or not as good or yada yada. And that's how money's made, right? Exploiting inefficient markets, which we have because we don't always know all the information that we need to know. And a lot of the market participants don't do any homework. Can you believe that? People that don't do homework, who would buy a stock or an option or sell a stock or option without doing their homework? I don't know anyone that would do that. And certainly anyone in this office that attempts to buy or sell a stock or option without doing any homework will be put into a closet. That's right, I heard you over there. Anyone that does that will be put into a closet until further notice, and their paper trading privileges will be revoked. Okay. So, CF Industries, we're talking about 13.71%, profit margins 31%, operating margins $1.5 billion in free cash flow each year. It's trading at a forward PE of around 11.5. The trailing PE is about 17, but the forward PE is pretty darn smoking hot, and it's got a PEG of less than 1, all of which are great things for us over here at Magnum Opus Financial. In fact, a PEG of less than 1, that's the PE divided by that 5-year average growth rate. A PEG of less than 1, that's pretty terrific stuff. So we like CF Industries. We do like the whole space. We do have some Potash bets, some Mosaic bets, the whole shenanigans, all the 9 yards, every bit of it. We like the space. There's a lot of argument for food shortages coming in the coming whatever. Obviously, the way to boost your crop yield is to use fertilizers, and of course, that means CF Industries, Potash, and Mosaic. So we like the whole space. We like the chemical space. That's another space that we like a lot. So do your homework on that one. Last trade for the day is a collar trade. That's right. It's not just this thing around my neck that holds my tie in place. A collar trade is a long put and a short call on the same stock. Your stock's your neck in the middle. You want to protect your neck, meaning you don't want to stick it out there to be chopped. So you put a collar trade on there. There's a ton of stuff going on in Peru. The elections are next week. The Peru Stock Exchange was down 5% yesterday. BVN, SCCO, those are kind of material positions for us, meaning we have several hundred shares of both, and we need to protect our profits. We've been selling put spreads against them, meaning that we've been lowering our break-even point, our cost basis the whole way along. That's been going extremely well, but this close to the election, you'd hate to give up a big gain in exchange for who knows what. I mean, could they get nationalized? Sure. Right now there's a national strike on like all mining companies in Peru right now. It's just a very politically volatile situation, which is of course the risk that you take on when you invest internationally, that being political risk. So the best thing to do is we just put a collar. Short call, long put. On BVN we did that at 44, meaning we can actually hit the eject button for more than the stock is worth right now. We used the money that we took in from selling the call, to buy the put, and that allows us to hit the eject button should anything go wrong in the elections, eject our stock. That'll create a whole bunch of cash for us. Again, the money that we've made in the stock has been on dividends and then on selling the put spreads against it. It really hasn't been, effectively the stock is pretty much where we bought it, but it's selling all these options against it each month that's brought in the money, which has allowed us to be able to put on this collar trade and kind of say, so what, whatever happens. So we put a collar on at 44 on BVN and at 36, I think, on Southern Copper, which is SCCO. We have no risk. Our only loss will be the cost of the collar. So I think it was about 20 cents per collar for BVN, and then I actually didn't check the cost on SCCO, but it was really low, extremely low. maybe 10, 15 cents to put on the collar. Maybe it was 20 cents there as well. We just had a smaller position in Southern Copper. But the reality is, when there's great uncertainty, most of the time the wrong thing to do is to panic and freak out. The right thing to do is, if you're really concerned about further downside, buy puts, right? Put a collar on something. Get protected. Find an option strategy that'll get you protected. Otherwise, you're going to bail out of your stuff at the worst possible moment. And that, my friends, is a rookie mistake that professionals make repeatedly. So, learn from that, right? Don't make mistakes. Go out and buy protection if you're terribly worried. That's the right thing to do. Then the worst that you can do is lose the money that you pay for the protection. But again, if you're using options to protect yourself, you can usually sell a strike above it, sell a strike below it, turn it into a butterfly, turn it into a straddle, turn it into a strangle, right? There's all kinds of things that you can do with options, and that's why we use them so much, and that's why they're so beneficial. That's why you need to do your homework and learn how to use options to make money in the market. Thanks for joining us again today at Lunch in the Market. Don't forget to be back for another episode tomorrow, because you're going to learn even more. Enjoy it. If you need this in writing, visit stockpicker.com. There's a Lunch in the Market every day, or go to magnumopusfinancial.com/lunch, or go to magnumopusfinancial.com and click on Lunch in the Market. Get this in writing, watch the video, check out the past episodes. See you again tomorrow. Have a great afternoon.